Okay, so in this lecture, we're going to talk about partnerships as our second entity that we'll cover in chapter 14. All right, so by now we should have a basic understanding of the sole proprietorship, how it's created. It's a default entity. And there's a lot of similarities between the sole proprietorship and the general partnership. All right, are the partnership. If we say partnership without a modifier, we're talking about a general partnership. Because as we proceed in this chapter, we'll talk about other types of partnerships. Okay. The only difference and distinction is obviously partnership is set up for by two or more persons, and that's legal persons, which can be persons of natural birth, like you or me, or business entities. So two business entities, i.e. two corporations or a corporation and an LLC, can also form a partnership. All right. So you'll want to be able to know when a partnership exists. Okay. For instance, an employee profit sharing program, where when the business is profitable, say I'm a small business owner and I have one employee, right? So I can't guarantee a lot of salary, but I do offer profit sharing. When the business is profitable, I pay my employee, in addition to his or her salary, I pay 15% in profit sharing. Well, is that a partnership? The answer is no. And the reason the answer is no is because I only share profits. To have a partnership, you have to share profits and losses, right? Joint ownership, right? It means that, and it doesn't have to be equal, but there do have to be, both partners do have to have an ownership stake in the business. All right. And then the right to make management decisions. So that's generally a vote on important business topics. So when those things exist at the same time, partnership is likely to also exist. Okay, so when we talk about partnership law, most partnership law is common law, but there is also some statutory law that enters into the picture. So those are the relevant sources for partnership law. And here's an instance where the common law is not followed anymore, because all states, virtually all states, have statutes that contradict the common law. If you remember from our hierarchy of laws, statutes would trump common law or established practice. But the common law rule for comparison was that the partnership was not distinct from its owners. So that should remind you of the sole proprietorship. It's not a separate entity from its owners. But however, in most states, the partnership is a separate legal entity. All right, and all that means is that it can sue and be sued. It can own property. All right. When a partnership, and the main reason for that is because the partnerships are taxed as pass-through entities, which means they have to be recognized as a legal entity because they have to file an informational tax return. And when I say an informational tax return, the partnership entity itself never pays any tax liability, at least not income tax liability. The individual partners, however, do. So the way taxation works, the partnership will file a partnership tax return and then detail each partner's share of their partnership income. All right. And it's the individual partners that are taxed on that share. So if I own, 50% of a business, that earns $10,000, then my share is $5,000. I'm going to report that $5,000 in partnership income on my personal tax return, and I'm going to be taxed at my own tax rate for that $5,000. All right, so the partnership itself pays no tax. The individual partners pay tax on their share of partnership income. All right. Okay, moving on. Partnerships are created. Well, you think back to our chapter on contracts, right? Partnerships are formed contractually, so they can be written, oral, or implied based on behavior. All right, so that should sound familiar. Should take you back to chapter 10. If the partners employ an attorney in the creation of their partnership, which you don't have to do, although it may be prudent to do so, the attorney will often draft a document referred to as the Articles of Partnership. All right. Now, in this document is how we want our partnership to run. All right. Because what we'll find over the next few slides is there are several default rules that are applicable if partners don't specify something else. So you want to think of the partners as they have the ability to make their partnership pretty much how they want. But if you don't specify certain things in the Articles of Partnership or in your partnership agreement, you'll end up with default provisions, which we'll reference in the moments to come. All right. Let's take a minute to talk about partnership by estoppel. This is actually not partnership, at least in the legal sense. This is an equitable remedy that allows court and a judge or jury to hold a person liable as a partner when they have represented themselves as a partner in a partnership. So let's say, for example, I am a sole proprietor, all right, and my dad is an established business person who has clout in the community, and so I call my dad and say, I need you to represent yourself as my partner so I can go to the bank and get a loan. All right, and my dad agrees. All right, so I get the loan because my dad is sitting right next to me and he says it's a partnership. All right, the bank makes the loan. Later, I default on the loan. I don't pay it. Now, I'm going to be sued. Now, when I say, well, actually, this isn't a partnership, it's just me, I'm a sole proprietorship, well, not quite, because I represented myself as a partnership, and my would-be partner, that my father, agreed. So, effectively, he represented himself as a partner for me to get a business advantage. And the reality is the courts are going to hold both of us liable as partners for that reason. And that's partnership by estoppel. It's an equitable remedy. All right. Let's talk about partnership rights. All right. So we've previously talked about, now these are the default rules. So you can change most of these in your articles of partnership, in your partnership agreement. All right. So management. All partners have equal rights. Each partner has one vote. So conceptually, this would go without regard to contributions. So if we're partners and I contribute $100,000 to the business and you contribute 20, unless we've agreed otherwise, we both have equal rights, equal votes in management decisions. Right? If I want to have more by virtue of my larger contribution, I would need to have that documented and you agree to it in our partnership agreement. All right. Here's another one. Interest in the partnership profits. Profits are shared equally unless you agree to something else. Okay? So again, same scenario. I've invested $100,000. You've invested $20,000. At the end of the year, the partnership has made $100,000. Well, my share in profits is $50,000. Your share in profits is $50,000, unless we've agreed to something else, right? And the taking that rule one step further is losses are shared in the same way profits are shared, unless you agree to something different, unless the partners have agreed to something different, which means that if the partnership lost money, we're going to split that equally. All right. Partners have no right to compensation unless otherwise agreed. So if I work in the partnership similar to an employee, well, I'm not an employee, I'm an owner, so I'm not entitled for compensation. Partners do have the right to inspect the accounting records. All right. And since the partnership is an entity under state law, partnership property is owned in the name of the partnership. All right. Okay. We've got a couple of duties here as well. Partners are a fiduciary to each other. What does this mean? It means when conducting partnership business, partners have a responsibility to do so in a manner in which they conduct their own business, and also loyalty, which means no self-dealing. I cannot, as a partner, circumvent or take an advantage or a business relationship that would benefit the partnership and take it for my own personal gain. That would be a breach of the duty of loyalty, right? And I'm actually going to discuss a case that deals with just that, the duty of loyalty. So I'll do that in a separate file. Partners are owners, which means they have the ability to bind or obligate the partnership if they agree to a contract. A single partner can bind the partnership. All right. Now, the single biggest drawback of the partnership is this joint and several liability. All right. So how does that work? All right. So let's briefly revisit and modify my ice cream truck example from the previous lecture. So I bought a van and I'm operating an ice cream truck, but I've taken a partner. My brother drives the truck Tuesdays, Thursdays, and Saturdays, and I drive the truck on Mondays, Wednesdays, and Fridays. Okay. Let's say that one Thursday my brother is in a negligent accident and injures somebody while driving the truck. All right. It's his fault. He was negligent. Well, what's going to happen? So we're going to be sued because in America, when an accident happens, particularly a business accident, there's going to be a lawsuit. All right. And the lawsuit's going to name myself personally, my brother personally, and the business. All right. And any one of those three entities can be forced to satisfy an adverse judgment. So let's say the business only has about $5,000 of cash, and the van was a used van. It's only worth about $5,000. All right. So if we get an adverse judgment for $50,000, the business doesn't have sufficient resources to satisfy that. And let's further say that my brother is also judgment proof. He doesn't own a lot. He's a renter. His car is not worth a substantial amount of money. But if I have assets, I'm going to be sued. So if I have, money in a bank account or I own a house, even though it was my brother who was negligent in the accident, since he's my partner, I could be held liable for the entirety of that adverse lawsuit. All right, so that's how that works. And again, very, very negative, very big drawback of the partnership, joint and several liability. Literally, with every single transaction, all partners are placing everything they own on the line. All right. Um, Dissociation. This is the process by which partners leave the partnership. Um, and this can happen for a number of reasons. Generally, whatever the partnership agreement says, or when the partners agree that a partner will withdraw. You can be voted out. Unless the partnership agreement says otherwise, it does take a unanimous vote when there are 3 or more partners. If there are 2, that doesn't work. If there are 2 and the partners cannot agree, it's what we call a deadlock, and generally the partnership is dissolved. If you end up in court with a deadlock in a 2-person partnership, the judge is just going to dissolve the partnership and liquidate it, sell off the assets. All right. Court order, and that's what I was just referencing, a judge's order, and you would commonly see that when there's a partnership and a 2-person partnership, and the partners have equal management rights and they cannot agree. That's deadlock. Court's going to dissolve that. All right. Bankruptcy or death of the partner. And this slide I should have removed, so we're going to keep going. Okay. So let's talk about the termination of a partnership itself. All right. Now, we're talking about these default provisions in the general partnership, but what we'll find is that the subsequent types of partnerships that we'll discuss also have these default rules with the modification of the joint and several liability. All right. So when a partnership is in a termination state or a dissolution state, that means that it is basically going out of business. And it can happen because the partners have agreed, maybe it's not a profitable business, or for whatever reason, illegality of the firm's business. All right. That means the company was doing something legal and it subsequently was outlawed. All right. Expiration of a stated time frame. Some partnerships are created for a specified period of time. All right. So when that lapses, that partnership will be in a dissolution state and wind up its business. And the last thing is judicial decree, judge's order. All right, judge can order a partnership to dissolve. Now, what does the dissolution process look like? Well, no new business, so no new contracts, no new customers. Any existing business can be finished up. All right. So if there were contracts in process, if you can think of a construction firm or anything like that, you can finish existing business, and you have to pay creditors, and that's the wind-up process. So if the partnership owes money, creditors get paid, and then once all the creditors are paid and all the business has been brought to a close, then any remaining partnership assets could be liquidated, which means sold for cash, and that cash would be split up amongst the partners and distributed. All right, and that's how a partnership ceases to exist.